Wanted to chat about a couple of things today. So first of all, this question continues to come up. What are the best investment opportunities today? And I'm recording this in mid-September 2024. Actually recording it right before the Fed decision. Is it a quarter cut or is it half a point cut? One way or the other, it's going to be a cut. So we're pretty clear in the direction of where the Fed is going. Of course, they'll be data driven and the speed of cuts might take a little while. But I wanted to point out a couple of things. One, the recovery in commercial real estate might have already started. Even though the Fed is just about to start cutting, Fed only controls Fed funds rate and the discount window. They don't control what the bond market does. The bond market has already indicated through the pricing, market pricing, that the interest rates has to be substantially lower. And how we saw it, we saw the peak of a 10-year treasury yield middle of last October in 23. It was around 5%. And now it's trading around 3.6%. So 10-year treasury yield has already significantly come off the peak. So financing options on the fixed rate mortgages in commercial real estate as well as residential, the pricing or the interest rate has improved. So the financing is still difficult to get. There's still limitations and other challenges, but at least the market recovery could have already started, although we don't know that. We can only see it in a year. Transaction volume has been still significantly low to date. In 24, 23 was very, very slow, of course. But we may see quite a bit of interest. New buyers or buyers who have been in the closet before they're coming out of the closet, simply because the Fed is expected to keep cutting rates over time and maybe historic buying opportunity. So we're yet to see where things are going to go, but the opportunity to participate in the recovery is now. Literally, things are starting. So there are two primary ways to participate. One, you can look for, let's call them deep buys, or deals that are being acquired from distressed sellers, not distressed assets, ideally distressed sellers that need to sell to raise cash. So these are few and far in between. You don't see too many of these deals happening. So when they do happen, that's wonderful. And if you can clearly see it's a great deal, the time is to participate now, because the forward return projections on the capital deployed now are sort of really strong on a historic level. Much, much better versus a couple of years ago, of course. The alternative to that, if you're not yet seeing great deals, new deals, is to participate in the recovery capital. I've used another term, rescue and recovery, but I like today the new term, recovery capital. So recovery capital is simply the capital that comes into the existing deals that have sufficient equity, but they are cash strapped. The equity, let's call them rich, cash poor, that need mass financing. They need additional capital that comes in between primary debt and previously raised equity to support these projects, to give them capital to finish work. And also, one of the most important buckets where these mass debt needs have come, the need is for, is to keep current lender, first lien lender happy. So we've seen a couple of these examples. In the recent iteration, all the first lien lender wants is to pay down on the principal of their mortgage. So it's not necessarily a bad situation. It's just the owners of the property, of the sponsor, or the general partner needs to raise some capital to pay down first lien lender mortgage to make them feel happier and replace it with the mass debt capital. Now, why would the owners want to do this? Of course, they don't want to do this. The bank debt is significantly less than the mass debt cost. But they don't really have a choice, because the banks are putting pressure on them, as banks might have regulators breathing down their throat, or simply part of the bank credit committee, they review things and they look at debt service coverage ratio and say you're out of compliance, pay us down a little bit. So there are negotiations that take place between the banks and the current owners. And as a result of these negotiations, they do come up with a need for fresh cash to pay down the bank. So from the new money perspective, it can come in with really attractive rates. So what do I mean attractive rates? Well, we've been doing this mezz debt loans, and we charge typically 20%, couple of points. Sometimes ask for an equity kicker. So these are great returns for the level of risk that these loans are taking. And the overall risk, the overall CLTV, combined LTV between the mezz debt and the first lien lender is not necessarily increasing. In fact, most of the money is being used to pay down the first lien lender. There are other alternative circumstances where the money is used to set aside interest reserves to pay the first lien lender, or set aside tax and insurance escrows. All those are valid causes. In some cases, the money is needed to continue renovations. One way or the other, if these projects are underwritten properly, they look very attractive because the capital that's coming in the mezz debt position is earning great rate of return of 20% and is not really taking a lot of risk. So it's drastically different versus the deals that were underwritten a few years ago with target returns in the teens in equity. Today, these returns in mezzanine debt look like equity. The equity-like returns without equity-like risk. So this recovery capital participation is a great opportunity today, given the market conditions. Over time, all depends what happens to the market. If the market recovers faster, then there will be very few of these great deals, great buys, and valuation improvements will obviously protect fresh mezz debt, and of course they will be very attractive for the equity players who are participating in the new equity on these deals. So again, deep buys or recovery capital, both are viable options, continue to be really interesting. I think from a volume perspective today, the best opportunities are available in the mezz debt recovery capital, because the deep buys are only very few, at least as far as we can see it. So that's that's a wrap on the best opportunities today. Appreciate you. Until the next time. Thank you.